I need to make a confession. A little more than 3 years ago, I did something I regret. And it's something I'm not very proud of. After getting out of training that the military puts you through, I racked up some serious debt. And so that really affected my DTI, which is debt to income ratio. In this video, I'm going to be breaking down what a DTI ratio is, how to lower your DTI, and what kind of DTI ratio you're going to need to qualify for different types of loans and credit cards. You need to know what your DTI ratio is because, let's face it, whenever I came out of the military, I think my DTI was 67%. If you don't know what that means, I'm going to explain it in just a second. But 67% is extremely high and very bad when you're trying to invest in real estate. Your DTI is taking your monthly expenses and dividing that by your total income. Before we can have an accurate number on your DTI, we need to find what kind of debt is actual debt that banks are going to look for when they're qualifying you for different types of things like credit cards, home loans, mortgages, etc. So I just have a few written down. I'm just going to read them off right now. That is, debt can be a mortgage or your rent, car payments, credit card debt, student loans, personal loans, and anything like that. There's some things that aren't considered into your DTI that you're still paying on monthly, meaning your insurance premiums, your utility bills, food, transportation costs. And now that you know what debt is actually counted against you, we're going to figure out what your DTI actually is and how we can actually lower that for you. And now we're going to add up all your monthly expenses. And when it comes to credit cards, personal loans, and all that type of stuff, I know you can put in more than minimum payment, but whenever banks are qualifying for you for a loan, they're going to be taking into account the minimum payment on those credit cards. And so that's what we're going to be using in this situation. So if you have a credit card and your minimum monthly payment on that credit card is, let's just say $20, you're going to put $20 into this equation. This formula is going to be unique to your situation. So you need to add up all your monthly expenses, but for simplicity's sake, let's just do this. Let's say you add up all your monthly expenses and that comes out to $2,000. That means your mortgage, your rent, your car payments, etc., all those different types of debt equals $2,000. And let's say you make $4,000 every single month. And this is very simple math. So let's take the $2,000 in debt, divide it by your $4,000 in income, and you're going to be left with 0.5 whenever you put it in the calculator. And so to get your actual percentage, if you don't know this already, you can times that by 100 and you can get your percentage, your actual percentage. So in this case, it's going to be 50%. Now, 50%, you're not going to get qualified for a loan. And in the case your DTI is higher than 50%, it's going to be nearly impossible for you to get loans through banks. And why is that? I'll actually go into that in just a little bit. And before I drop a serious knowledge bomb on you, hit that like button, turn it blue so the YouTube gods know this video has value in it. So this is a knowledge bomb alert. Let's say you and your spouse have a mortgage on a home. And now whenever you are going to buy an investment property and you're going to have it in your name, you need to think about it like a bank. They're going to take your entire mortgage that you and your spouse are on, and they're going to use that mortgage payment against you completely. They're not going to divide it in half because two people are on the loan. They're going to take all of that monthly mortgage payment that you're paying against you. So let's say your mortgage is $2,000 a month, and then let's say you and your spouse split it down the middle, $1,000. And so the banks are going to take that $2,000 and use it against you rather than the $1,000 that you're actually paying. And the banks they do this because let's say an unfortunate event happens and you and your spouse decide to separate, and now you keep the house. Well, now you're liable for paying that $2,000 every single month, and it's not half and half anymore. That's why the banks look at it the way they do. So that leads me into lowering your DTI and what you can actually do to lower it. You can lower your DTI by adding someone to a loan. So as a personal example, me and my wife, whenever I was getting to real estate investing, I had a very high DTI. Like I said, it was at 67%. Now I worked that down to, it was about 53% where I was starting to actually actively look for investment properties. And I was talking with the banks and there was no way around this. Every bank was coming back and telling me your DTI is way too high. It's too high. And so with talking with these banks, they gave me a great idea on adding my wife to the loan. Now, your spouse might not actually be willing to do this because it is risky, especially if they don't like real estate investing like my wife does. But by adding her, she has that additional source of income. Now, it's not going to work if your wife has a high DTI, like 100%, obviously, because then it's not going to lower it. It's actually going to raise it. Because if it's higher than your DTI, it's obviously going to raise it. But if it's lower, it has a very good chance of lowering your DTI. Because whenever you and your spouse are on the loan, they're taking all the expenses and then all the income. So let's just say you and your spouse make $4,000 a month, and then that equals $8,000. Let's just say, for simplicity's sake, the total expenses for both of you is $2,000 every single month. Now that's 2,000 divided by 8,000. That's a quarter. So 25% your DTI. That's what it's going to look like in the bank's eyes. So that's one way to lower your DTI. Another way to lower your DTI is, it's very simple, but it's very hard to implement. So it's decreasing your expenses and increasing your income. By decreasing your expenses, what I mean by that is you need to get roughly every single credit card you have below a 30%, because that affects your credit the most and that lowers your DTI the most. So let's say, for example, you have a credit card balance of $1,000 and the credit limit on that, let's just say $2,000. So it's at 50% DTI on just that credit card. Now, you're going to want to get it below 30%. So what? That's $500. You need to get that credit card balance below $500, $600, something like that. And that's easier to do than, let's say you have a credit balance of $5,000 and your credit limit on that same credit card is $10,000. Now you're going to have to get that down $2,000 compared to the $500 on the other credit card. That's what's going to help your DTI the most. And with increasing your income, it's pretty self-explanatory, meaning you ask for a raise, you get a second job, start a side business, etc. Whatever you want to do, that's going to increase your income. That's going to help you out in the long haul. But decreasing your debt is actually going to be quicker than increasing your income. So I promised you earlier in this video, I would let you know what the banks, what they specifically look for in a DTI. A 37% DTI is actually ideal for banks. 37% and lower, that's what banks are actually looking for. Because if you have a DTI of 37% or lower, that means banks are more comfortable lending money to you because you don't have obligations to other debts. So like I said earlier in the video, a 50% DTI, it's going to be nearly impossible for you to get a loan. So keep that in mind whenever you're wanting to either buy a home or buy an investment property. If you want to learn more about real estate investing, there's going to be a link down below to my top 5 real estate investment books. So go check those out. And again, hit that subscribe button and click the bell icon so you get notified every single time I upload a new video just like this one. Now, there's going to be a video popping up right now that I picked out specifically for you. So go check out that video. I really think you'll enjoy it. Until the next video, guys, I'm out. See ya.